Hey guys, it's Mr. Oxy coming at you live from Palm Beach in Florida. It is Monday. It is July the 18th. There's a lot of stuff going on in the energy market, and I thought I'll take a few minutes and kind of walk you through some of my thoughts and share some of the happenings that have been going on in the past couple of weeks. I'm not sure exactly what President Joe Biden was doing in Saudi Arabia, but I think he might have gone there to lecture them on carbon emissions, green energy, gender equality, or whatever the case might be. So I'm not exactly sure, but anyway, I did do a little bit of reading just to see if I could find out and share some information with you. So let's go. This is the New York Times, which obviously is very favorable to President Biden, reporting on his recent visit. And this is their language, not mine. It says, in the most fraught foreign visit of his presidency to date, Mr. Biden's encounter with Crown Prince Mohammed bin Salman, MBS, gave the Saudi leader a measure of international rehabilitation he sought. Well, that's kind of a bold statement right off the cuff, right? So Crown Prince Mohammed bin Salman needed international rehabilitation. Therefore, he met with President Joe Biden. Okay, the kingdom would soon pump more oil to relieve high gas prices at home. That was the understanding. We'll talk about the outcome of that in just a second. Mr. Biden's discomfort was palpable as he avoided a handshake with the prince in favor of a fist bump. That's an interesting one too, right? People have been shaking hands for, maybe more than a century or so. I'm not sure that world leaders should be doing a fist bump, but then over the past few years, we've seen them do the kind of elbow thing as well, right? The president made no mention of Jamal Khashoggi, which is one of the reasons why he said he previously, President Biden said he previously wouldn't give Crown Prince Mohammed bin Salman any standing because of Jamal Khashoggi, but he didn't mention it, according to the New York Times. He also said the prince smiled silently when a reporter asked if he owed an apology to the family. I don't have a comment on that. I don't have an opinion because I don't know what happened. The White House was eager to show the tangible benefits, assuming there were any, releasing a raft of accords negotiated by team lead Brent McGurk. Brent has been working for a variety of different presidents, I think, since President George W. Bush. So he's been in that role as a bureaucrat for quite some time, negotiating accords. Among them were agreements to open Saudi airspace to Israeli commercial flights, extend a ceasefire in the devastating 8-year-old war in Yemen. That would be a great thing. And build 5G telecommunications networks. Not exactly sure the Saudis need America's help to build 5G telecommunications networks, but there you have it. However, the New York Times continues, the accords simply ratify action that's currently underway. In other words, they're ratifying action that's already underway. For example, the administration said that Saudi Arabia would support global oil market balancing for sustained economic growth, without specifying how much additional petroleum the Saudis and their allies in the United Arab Emirates, would pump starting in the fall. That announcement is expected in August as part of a larger decision by the OPEC Plus group of oil-producing nations. Now, guys, that is an interesting thing, right? Because, and I've mentioned this before, President Biden is basically calling on OPEC to increase production. But OPEC, the plus group, includes Russia, Venezuela, etc., which means he's effectively calling on countries that are openly hostile to the United States to increase production, when arguably he could just, put a call in locally to the CEO of, or CEOs of Exxon, Chevron, ConocoPhillips, Occidental Petroleum, and say, please help us out here, man. We need to increase production. As a gesture of goodwill, you might even say, I'm going to approve some of those 6,500 federal leases that are currently on hold by the Biden administration via the EPA in order to prevent American fossil fuel companies from exploring and producing. Not a good situation. In other news, Gazprom, the Nord Stream pipe from Germany to Russia, transports 55 billion cubic meters of gas from Russia to Germany annually. Well, that's the history annually. That's what happened before. What's happening today, according to Deutsche Welle, I hope I'm saying it correctly, Well, Russian gas supplier Gazprom, which you can buy OTC, OGZPY, is conducting maintenance over a 10-day period, but there are fears among European countries that Russia would use this as a stop of gas deliveries in response to the sanctions slapped on it by the West. There's a little bit of 5D chess going on here, right? Gazprom's issued a statement saying that it expects the Siemens Group to unconditionally fulfill its obligations on the maintenance of the gas turbine engines, which is essential for the reliable operation of the Nord Stream gas pipeline. 5D chess, right? What you do is you threaten them that maintenance might stop supply, but then at the same time you blame Siemens, which is a German company. This just in, Gazprom declares force majeure on some gas supplies to Europe. Reuters reported at 10 o'clock this morning, this is today, July the 18th, Russia's Gazprom has declared a force majeure on gas supplies to at least one major customer in Europe. At least one major customer in Europe, might be German, Reuters said. The letter concerns supplies through the Nord Stream 1 pipeline, Reuters said, citing an unnamed trading source. However, the legal force of the letter is to shield Gazprom from compensation benefits for disrupted exports, Reuters said. Well, Gazprom, as I just showed you a minute ago, is already blaming Siemens for that one. Can you buy Gazprom? Not really, because of sanctions, right? But if you could, you'd be able to pick up Gazprom for $1.10 a share. That was earlier today, and this share is basically stuck as an over-the-counter share for me in the United States at $1.10, sitting at the left-hand side of its 52-week range, which is between $1 and $11. Imagine if you could buy this stock for $1. It's almost free, very volatile, almost 100% volatile. But what if you can't buy Gazprom? Could you buy Lukoil? Regrettably, no, you can't. But if you could, you'd be able to buy it at $7. I actually have a couple of thousand shares of Lukoil. I wish I could add, just to reduce my cost basis, $7, man. This is almost as free as the free, in inverted commas, that happened during the fall of communism when the Russians made vouchers available to ordinary people. And those vouchers could be exchanged for stock in state-owned companies. At that point in time, those vouchers were given to the Russian people for free. Many people didn't know what they were or how they worked. But this is like really, really close to that, man. If you can buy Lukoil for $7, it's almost free. So you might want to watch this one daily. Hopefully there's an end to the hostility in the Ukraine soon, or some peace agreement or something like that. And we can start trading this again, and maybe you can snag some Lukoil shares before it bounces back up to $100. 52-week range between $7 and $107. If you don't like volatile stocks, maybe you don't like Lukoil, because this one's historical volatility is 115%. Its PE ratio right now is free, 0.34. They don't come around too often. So if you can snag some Lukoil for, let's say, under $10, you might want to pick up some. So what can I buy, Mr. Oxy? Well, right now, what you can do is you can buy State Street's XLE. This is their ETF, XLE. Make a note of that one. You can buy it for $70, preferably not today, because it's up. When I took this slide, it was up 3%. I would prefer to buy it when it's down 3 or 5% rather than when it's up 3%. But anyway, $70 for an ETF share, not a bad deal. It's almost free. It doesn't cost you anything. The net expense ratio is 0.1%. It even pays a nice, big, fat, juicy dividend of almost 4%. $2.80 is currently yielding 4.09% at its share price of $70. Sitting in the middle of the 52-week range. Morningstar shows it in their Morningstar style box as a large value stock. And more importantly, at the bottom right, the risk is below average for sure right now. The return is high. I would almost say, if you ask me, can I buy XLE today, Mr. Oxy? I would almost say, sure, go ahead. You can buy some for $70, not a problem. It might pull back a little, obviously, because energy might still bounce around a little. But at the end of the day, you'll be okay at $70. What else can you buy? Well, If you're okay with single stock risk, Devon is quite nicely priced at $54.61 when I took this slide. Ideally, I would like to buy Devon, if I did, for about, I don't have a position, for around sort of $49, $50. In fact, $50 would be a really good price to pay for Devon Energy. It's currently also sitting in the middle of that 52-week range. It's a profitable company, $36 billion company. It's got a PE ratio of below 10. Its dividend right now, $3.60 on an annualized basis, is yielding almost 7%. There's not too much wrong with Devon at $54, although I would like to buy it rather at around $50 if possible. When I took this slide, it was up almost 4%. So wait until there's a bit of a pullback. You can buy some Devon. What about Occidental? Well, you can buy Occidental for $60. It's probably a good deal too. It's got a little bit of run rate left here just in terms of getting back to its 52-week high, which was $74. Profitable as well, with a PE ratio even better than Devon Energy of 8.9. However, there's a little twist to the tail here, right? Because right now, Uncle Warren Buffett, Berkshire Hathaway, owns almost 25% of Occidental Petroleum. So there's a really good chance. I mean, it's very, very probable. Obviously, I can't speak for Mr. Buffett, but it's probable he might want to take the company private. Hopefully, if that happens, it kicks in for us at a premium of, I don't know, 25, 30% above where we are currently trading. It'll be a forced exit for us because there's nothing you can do about it. So hopefully you can make a little bit of money. And it's going to create a tax event as well. So keep that in mind. Also, it might give you an opportunity to dump some of your underperforming stocks to take a tax loss in order to offset against your Occidental gains, if that were to happen. What else is going on? It's just a couple of headlines and I'm going to wrap up here. So the energy crisis prompts ESG companies to rethink oil and gas. ESG, for those who don't know, is environmental, social, and governance. We rank and rate companies based on their environmental, social, and good governance scores. And then we decide we're going to invest in those companies based on ESG rankings. That's the stupidest thing ever, because in the first place, E is not equal to S, and that is not equal to G. These things do not belong in the same sentence together. They are not the same thing. But it's even more stupid because it precluded them from investing in the only sector that's been an outperformer, which is energy. So, hey, you know what? If you want your shares to tank and stay there, then focus on ESG specifically. If you want to make some money, you might want to be in energy. Investors are starting to look more favorably on energy companies because of their role in the transition to a decarbonized economy. So now suddenly companies like Occidental Petroleum and Oxy's low carbon ventures starting to look attractive to ESG investors because they missed the entire bull run from companies like Occidental that they could have bought for $10 a share, and it's now trading at 60. So they could have had a 6x on their return instead of a negative return of 60% because of their ESG investments. Rig Zone reported that OPEC producers will need to pump crude at the fastest pace in 5 years in 2023. Guys, that's next year. So you've got another at least 12 to 18 months of energy being bullish for you before you need to kind of maybe hedge or start exiting some of those positions and diversify into something else. Capacity constraints suggest that the companies may struggle. The latest forecast from the International Energy Agency, the U.S. Energy Information Administration, and the Organization of Petroleum Exporting Countries all show global oil demand rising strongly again in 2023, despite growing fears of mounting inflation and weakening economic growth. And despite President Biden's release of the Strategic Petroleum Reserve in the United States at a rate of 1 million barrels per day, plus everything else he's doing to kill fossil fuels, here we see on the left-hand side, courtesy oilprice.com, crude back at over $100 as of now and climbing once again. So everything that was done did not work the way in which they had intended, simply because we have a lack of supply and ever-increasing demand for energy. So I'm going to leave you with this. If you need to give someone a fist bump today, then make sure you have a saluting officer in the background to make sure that you put yourself in a winning position, whatever your negotiations might be. So on that note, guys, this is Mr. Oxy signing off, saying thanks for watching. I'll see you soon. Bye-bye.